My guest today is Denis. Denis is a principal at I2BF Global Ventures, a New York-based fund with more than $400 million under management. They bet across some serious different industries. Now, Denis joined I2BF as a young analyst, has spent over 12 years there and personally reviewed more than 11,000 startups in that time. His thesis is the opposite of what most VCs are chasing in 2026. Instead of pure AI plays, Denis hunts for frontier tech transforming what he calls the boring industries: construction, manufacturing, logistics, utilities. He's also a former rocket scientist with 2 master's degrees out of Moscow Institute of Physics and Technology, and he co-founded Space Ambition, one of the leading communities for SpaceTech founders. Today we go deep on how he picks winners in unglamorous markets, what 11,000 pitch decks teach you about fundraising, and why he thinks AI hits a turning point this year. Denis, welcome to Deal Makers and Fakers. I'm super excited that you are here today, Denis. Thank you so much for joining this session. Actually, this is our second session now with an investor, and in the previous episodes did a lot of sessions and recordings with startup founders and other operators who talked about their journey, how to raise capital. So now it's getting even more exciting in my opinion, because we look from the different perspective, from the investor perspective. And I directly have my first question to you. What would you say is the most overused buzzword you saw in pitch decks in 2026 so far?
AI.
Okay, but would you say that AI in the moment is something your fund is interested in? Probably yes, from what I saw on the website.
75% of the founders, startups which are raising funding claim that they are AI companies. So of course, it's not about just the buzzword. For us, it's more about looking into and understanding does it really make sense to use it? Because, for example, at I2BF, we invest in so-called transforming boring and unsexy industries. So whether it's healthcare, whether it's construction, logistics. So what we look into is, does it make sense to use AI agents or something, or it's just the buzzword? Many people just use it, don't really have any AI.
That's true. I actually also heard a podcast last week from Harry Stablings from 20VC. Great podcast also, by the way. They also spoke about that topic. So one example he mentioned was a company that is building AI agents in the insurance space. But why does every company now has to say agents or AI? Because in the end, it's really more about what is actually the value they provide. So maybe they make the claims process easier or stuff like that, but you don't always need to say AI. So I definitely agree on that. I did a lot of research on you as a person, and I think your profile is very interesting. So I saw that you studied a very interesting topic, space engineering. And now my question is, if you would not write checks right now, would you think you would do something like flying rockets or running a startup right now? What do you think?
2006, when I was about 20 years old, and I started as an aerospace engineer, I understood that I'm not the person who is passionate about doing technology. I'm more like a person who likes to communicate to other people. And I've seen many smart people doing smart technologies, but they couldn't build business around it. So I decided to become someone who would be building business around technologies and earning money and then reinvesting it in fundamental and applied research. Would I be doing a startup? First of all, I tried and failed. Oftentimes, I've thought pretty thoroughly about it, and I understood I don't want to build a startup myself.
So you work now for I2BF for quite some time, and I'm just wondering, do you have any specific industries you focus on? From my research, I saw you do a lot of deep tech. So you are not only focused on what you studied, basically. You are a little bit broader, and you focus a lot on the deep technologies that come in and land in the funnel for your fund, or how does it work?
First of all, the reason I joined I2BF was their investment in a SpaceTech company. And so it was like a passion. So it was a company called Planetary Resources. So it was backed by Larry Page and Richard Branson in 2013, and they were going to mine asteroids. And back at that moment, I was working in a bank, and you can imagine these guys are fulfilling your childhood dreams while you're sitting in a bank and doing boring Excel spreadsheets. So this is why
that's interesting, Denis, because actually the same applies to me. I was also sitting in a bank. I did my apprenticeship there there. And I always thought, oh wow, there has to be more. Like, this is so Boeing. And I even had lists then, and I had to call like people and sell them stuff and bring them like to the location there. And I didn't really like that work at all. So I was then also super happy when I jumped into the startup world. So I just wanted to say, like, we had the same history, basically. I like that.
And actually, I met many people who work in corporates, and they actually, sometimes they say they want to build their own startup, but they try to escape from their boring job. And oftentimes it's not doing a startup, and I sometimes navigate them. So I joined I2BF. I gained my expertise, first of all, through all sorts of industrial solutions, whether it's discrete manufacturing, like, energy sector, logistics, construction, and stuff like that. So I went to like very sophisticated industries, and we looked into solutions, how we can, change those industries, either using hardware or even some very sophisticated technologies like quantum computing, for example, or using like more basic solutions like IT solutions, IoT, combination of both, etc., bringing value. Initially as a physicist and as an aerospace engineer, I kind of understand how those deep tech companies or tech investments are done. And
that's interesting. And I think specifically deep tech is an industry where I see a lot of companies and founders struggle with fundraising. First of all, because you need a lot of money to be able to get some sales in. And in general, like, you don't have so many investors who focus on that industry now compared to like the average software business, at least from my experience. So we will speak about how you select these type of companies and run them through your VC funnel in a bit, because I think that's a great topic. In regards to the industries, I think I actually saw a quote from you where you described basically or called the industries you work in as Boeing industries, which I think is quite interesting, because many people always say that you have to go into these more established Boeing industries and there you can earn money. And I think this is so true, because everyone is always hyped about, again, the buzzwords and working and operating in like sexy businesses. But I think there are a lot of industries that need way more attention. And from my research, it seems that you are exactly basically working in these industries. So that's amazing.
Yeah, I want to expand on that. So, and now in the era of AI, it becomes even more reasonable topic, business strategy, because AI companies and IT companies, they are the biggest adopters of AI for various applications, and it's tough to sell to them. While if you sell to a manufacturing company or to construction company or like to farmers or so whatsoever, they typically want to pay for solution, turnkey solution. They don't want to build it themselves. So you end up having a more sticky product, higher LTVs, etc. And now, oftentimes, VCs always say, like, what is the secret sauce? What's the barrier to entry? Why is it not easy to replicate your product? And for those legacy industries, there are many modes, and they are not coming from the technology, but they're coming from like industry insights work. So going to those legacy industries makes sense now. The other thing quite important that you don't often meet in those industries, combination of person deeply understanding the industry and people in person deeply understanding like how technology, IT, AI works. So if you're going to this industry, you probably will be dependent on the industry, of course, but you will probably quite unique, and competition could be not as crazy as in some sexy industries.
And when you say legacy industries, or in general, like, is there in the moment one industry where you would say, okay, this is like the next industry where I really have a lot of attention on right now, or where my focus is?
We actually look like from pretty wide, so I wouldn't say like one specific industry which you should definitely go after. Now what I see is that people say, okay, now AI opens up more possibilities to developing solutions, making it more flexible, and let's like grab any industry and see like what we can do here, and where we can replace like manual, like tedious work with some solutions. And the other thing what's happening is that previously, for example, in some industries, the IT solution had lower penetration because it was pretty costly to develop them, and now you could do it like at lower price, and the penetration of this digitalization, automation, AI stuff is happening in wider spectrum of industries.
Perfect. I think also like a lot of people are always waiting for Y Combinator when they announce like their focus industries they want to invest in or they want to partner with, or sometimes that is also quite interesting.
personally myself, I am a big fan of Andreessen Horowitz rather than Y Combinator.
I have another question. So on my research, I saw that you started in the VC world in 2014, right?
Yes.
Okay. Now I'm just wondering from your perspective, is there anything that changed in these years? I mean, it's already like quite some time. So it's now 2026, obviously. So do you see like big differences between 2014 to 2026 from a VC investor perspective?
Yeah, it is. First of all, when I started working in venture capital, it was a common concept of presentation and elevator pitch. So it meant that attention of the VC was so scarce, so that founders, sneaked into the elevator and they pitched their idea for 30 seconds while you were going up. So that's
amazing.
It showed that founders were in such immense need of the funding, and it was so hard to get that funding, so that they had to do that.
But I like the effort. I like the effort. Like it sounds way better than just sending like cold emails on high volume to thousands of investors at the same time, to actually be there in the elevator and find the people, do the pre-work, and then go for the investors who might be perfect fit. But of course, I understand, like for the investors, it's probably a little bit annoying, but sounds definitely like a big difference to today.
This is where the other thing which started to change, especially after the lockdown, investors has become much more open for this cold reach outs, etc., because the sector became like immensely big. So we Andreessen Horowitz, for example, they started in 2009. Now they have $50 billion or more under management. Like it's a financial monster. It's not a VC, to be honest. All in all, and of course, since 2014, so first of all, investing in SaaS became sexy.
Yeah.
In 2014, it was not like that such a wide trend. Now everyone invests in SaaS. Now everyone invests in AI, but previously everyone was investing in SaaS. So it became kind of like standard, like to do safe notes, while previously it was more like about doing convertible notes. It also became the market standardized, and seed rounds grew in the size, and VC started to require more revenue traction. So the seed rounds now, as we know them, as we call them, they previously were Series A's. And all in all, what also changed, late stage VCs invest in B, C, D, E, F, like billions on tens of billions of dollars company investments in private companies. That became extremely popular because previously it was not that much of a capital which you deployed. So for example, if you look at Google, before they went public, they raised only $35 million. Like
wow.
Uber raised like billions of dollars before they went public. That's the change. Then many new entrants in the field emerged. The secondary markets, or for you selling like your allocation in the private companies, to also grew immensely. Many new people came in the industry, so sometimes I call them tourists. All the industry was growing, and like you're kind of indexing the whole growth of the market. So, and this spray and pray mentality, where you just like your main goal is to put more money into quite a spectrum of companies. It worked even before, because that's the power law which works in venture capital. It causes this, but it became like widely spread. Investments became more narrative based. Like you need to understand, like we're at the end of this cycle. If someone thinks that it will be continued that way, no. First of all, like we've passed the peak around in 2021. Then it was like annual investments in venture capital doubled compared to 2020, and they dropped significantly, like 2x to the pre-COVID times. Now we see this, wave of AI startups raising money, especially those huge startups. While the volumes of investments is growing now, it's going to later stages, fewer companies. And if you look at the count of the early stage companies, like the number is declining. So it dropped over the last couple of years. So it dropped 30% of those pre-seed and seed funding. So for seed founders, like if you're top 10% of the founders, it's easier for you to raise funding than the rest of the 90%, because big funds will ship a lot of capital in your company. But for the 90% of the market, you're like in a much worse position than those top 10%. This transformation of the market, correction in the market, it's going only up. It's illusion.
That's true. And I think it's like a super interesting discussion because we, of course, also see that. And when we look at the numbers here in Europe, we also see that a lot of the big funding rounds that are happening are all going to the same late stage companies. So probably at least like 60 to 70%. If I'm not wrong, I even did a LinkedIn post about that where we analyzed like a lot of the last funding rounds, and globally, it's exactly also what you said. So Anthropic and OpenAI, they also count, of course, into the VC investments or venture investments in general. But if you then look on the other market or the other numbers, it's not that high as it looks like initially, just because of these very big AI companies. And that's somehow making the market a little bit looking fake, I would say, because people think, oh, it's growing. And yeah, the numbers are growing, but I would say the market is just getting way more selective and way more difficult. And also personally, I'm very skeptical about a lot of AI software businesses as well, just because of what AI can do now. When we look at Anthropic again or these other companies, like they can replace most of the software companies so quickly these days if they want. But this is another topic. Before we open that up, I would like to speak again about your fund, because I saw that you are already now in the fund number 5, if I'm not wrong. So I would like to understand better the fund perspective also, and what changed maybe between fund 1, fund 2, fund 3. Like, are there any learnings you had during that time? Any changes or pivots you made with the fund or focus areas? That would be super interesting.
We initially started as a clean tech fund, an energy fund. Then we expanded to a broader industrial applications, and then we expanded to the more software play, transforming this wider spectrum of industries. But it's always the case with VCs, because the VC market changes, and types of the startups which you backed a decade ago are not can't bring you those profits as you had previously. So you need also to change with the narrative. And for example, you mentioned that deep tech startups is in bad position now. It's harder for them to raise funding, but the percentage of those deep tech funding is growing. So a decade ago, it was only 10% of the companies. Now it's 20%. And with AI, actually, when you can build many software which previously brought you a lot of fast returns, now you can't do that. And I believe that deep tech will be growing just because it's something which is not easy to build and gives you a potential upside. The numbers show that this thing is growing. For example, we all talk about AI, but AI needs data centers. To build the data centers, you need a lot of technology in the data centers. You need energy for the data centers. You need a network for the data centers. So you need a lot of stuff. It could be done by software, purely software. So this is why I'm a little bit more optimistic about deep tech. And I see that more funds emerge in Europe, which are going after the deep tech topic. For example, I visited the biggest sustainability conference in Europe just a month ago. And there were pretty many interesting conversations around various energy transition technologies, both hardware and software.
Interesting. And I agree. I think Europe is quite good when it comes to deep tech. But does it mean, you briefly mentioned that, so you see also a lot of investors who are now also changing their own investment thesis? Is that what you currently also see, that they shift, for example, away from pure AI or software and invest more into deep tech, or even deep tech hardware companies? Is that currently something that you see?
I wouldn't say that this is mainstream, but definitely they diversify. So I see more people who are launching funds with focus on space tech or energy or something. The other thing which is changing, for example, in Europe, VCs have the main LPs for the VCs in Europe are government funding, and sometimes they just require, AI is okay, software is okay, but probably we need to support some other technologies, which are strategic, for example, quantum computing. So, and there is some pressure on the LP side, which is also pushing this direction. But still, I wouldn't say this is like 50 or 70%. But I see more interest to looking into some alternative solutions, not only purely software solutions.
And now you already mentioned LPs, so I would love to speak about that topic, since we also spoke about fund number 5 now. Have you been involved actually in raising one of these funds, and are you also responsible to manage relations with your own LPs?
Yeah, I did. For those founders who listen to us, if you believe it's hard to raise funding for your startup, try to raise money for your VC. Because when you talk to a VC raising funding, you're talking to a person who's in charge, like day and night, deploying capital, and their like main job function is to talk to you. While if we talk about raising money from LPs, these people, there's a wide spectrum of people and organizations who could be your potential sponsors, not sponsors for potential LPs, but they don't necessarily want to invest in the VC at all. So you need to persuade them, and they are those people. They are professional financial people, and they scrutinize their decisions and trying to understand like which fund is better to back. And many VCs, they look the same. We have tens of thousands of VCs. Like me, they look the same. How you pick between them, especially given that they sell you the idea to invest in your company, like in their VC, like for a decade, and they say, okay, we will give you the returns, but
it's probably difficult to have like a differentiator when you're raising for a fund. There are like just a couple of options. Like you can say, okay, we actually have access to the best and most high quality deal flow. Then you can of course also show like potential returns that you already got like with your previous funds. And then you can maybe say, okay, but we are very technology driven and we have implemented a lot of AI processes that help us to do. Yeah, exactly. And I just wanted to say, so yeah. Or do you see, like, is there anything else you see apart from these 2 or 3 things?
So the main differentiation, of course, is depending on how big is your fund, how long have you been in the market, and what type of the brand have you built. Big funds, of course, they invest across the industries, but smaller funds, they focused on some subsegments where they understand best. Generally, there are generalist funds which can essentially invest in everything, and there are many funds like that in Europe, just because funds are obliged to invest in startups out of their country. This is like LP limitation. Vertical VCs, these VCs which understand some niche, they could make better decision because they better understand what's happening inside. One layer of differentiation, you go into specific niche or several niches and become the king of those niches. VCs are adding, especially if you're working in a very sophisticated niche, so you try to add some added value with business development and relevant network, which could help your portfolio companies. Yeah, all in all, like you differentiate by the brand, the network you have, the reputation that you've built.
What are like the type of LPs that you currently have? Like, are these people who are mainly high net worth individuals or like pension funds, or is it like a mix?
In general, there are many types of LPs. I even once did a lecture and a dozen of potential LPs and types of LPs. It's high net worth individuals, family offices and groups, funds of funds who are doing professional investments in various funds, some ecosystem building organizations and development funds, sometimes even like military and special service units, etc. Some LPs are purely financial driven, while some LPs' main goal is to support some specific type of technologies because they need them for their reason, and the returns is the second reason they support something. For example, there are some LPs who support, for example, energy companies, or it's strategically to be built, like, for example, in Germany.
Perfect. Let's move then to the next and most important topic. Obviously, I'm quite interested to hear more about how your deal flow process looks like and how the first call looks like when I would now have a call with you. What is like your process when you speak to a founder? Like, how many pitch decks do you see per week? And then how many of them actually make it to to the first conversation with you?
So it varies from week to week, but these are like hundreds of pitch decks a month, I would say. So the thousands a year in various.
And do you actually go through all the slides, or is there something where you say, okay, now
there is a service DocSend, and they collect statistics. So the average time VC spent reading the pitch deck is about 3 minutes. So this is why both your email when you could reach out someone and the pitch deck, they should be like ticking the boxes about the market size, competition, what you're doing, stuff like that. Believe me, the many emails which I read, founders wouldn't be reading them themselves if they receive it, because they are very generic, like either like very long and you can it's difficult to figure out fast like what they are selling, or it's totally irrelevant. For example, I do manufacturing and I'm getting emails about like cancer treatment.
Oh wow, problem. I heard that, by the way, quite often. So also like I received one email that was quite funny. I actually published that on LinkedIn and it got like 200k impressions or something, where a person approached me and it was anonymous, like already that is quite weird, and they wanted to ask for like $20 billion and it was like, dear sir or madam, and completely out of nowhere, not even optimized for anything. I mean, yeah, it's so easy to do like pre-work, but still a lot of founders don't do it. So I think
understand why founders do that, to be honest, especially for niche solutions like industrial or energy or stuff like that. It's better to do this, filtering and looking into a more narrow list of, 200 VCs rather than sending to 8,000 VCs. For example, if you're a German fund and you say, okay, I'm a German startup doing energy and you're doing energy and energy and industrial applications. So those VCs naturally don't have like tremendous pipeline, especially if you have a strong business background. So you're already in top 20% of their funnel. So they will be, okay, it's time to have a conversation with those people.
That's interesting. These are some very, very good insights. And now, Denis, since we are moving to the end of this episode, I just have prepared a couple of very, let's say, easy questions, and I would love to get some quick answers on that. Okay. It's a lot about specific advice now. So if you would now think about the average deep tech company, like, isn't there anything specifically in the pitch deck or maybe from a KPI perspective that you always want to see that tells you, okay, this is now a high quality deal I should do discuss in a call now?
A lot of those pitch decks, they are built around technology because typically they are done engineers or scientists. Fewer of them are focused around the business actually. And I understand that it's not immediate, you will have this business in a couple of years, but stressing on your business perspectives and ideally having a business persona in a team, and even if you don't have sales but only have MOU, it will help you to stand out. Sometimes you're too focused on building the technology and you say to yourself, okay, we will be figuring out the exact application in 2 years. Especially, as I said, I'm passionate about space, and I talk to space founders, and they are passionate about launching something into space. It doesn't always make sense just because the markets, space markets are in their niche are non-existent or very tiny. And what they don't do, they don't look into potential applications for their technology here on Earth. And it could be 95% revenue is coming from Earth, while 5% is only coming from space. And there are some unusual examples. For example, there is a company producing orthopedic mattresses, and they used the technology from astronauts, which was used for cushioning astronauts during the launch. But they applied for orthopedic mattresses, and that's not the mentality you see often, thinking outside of the box, because and finding bigger niche, bigger market where you could adopt the technology.
Denis, I have one last question, and really appreciate already the great answer you gave me. That was great. What is your biggest red flag in the first investor meeting?
Sometimes you get to the meeting and you understand that during the email conversation or when you looked into the pitch deck, all the results were extremely exaggerated. And you get to the meeting meeting, and after 2 or 3 minutes, you understand that it's not going anywhere because I'm doing like investments in startups which are have this traction, and the guys which I'm talking to, they're like a year or and a half before that. So it means this conversation will make sense in 18 months. So it's not direct flag, but it's like you understand, like it will be a waste of time. Of course, you listen, you ask questions, and it doesn't really make sense for the founders just because you waste your own time, because there are VCs which are focused on you on your stage, and you'd better spend your time talking to those VCs where the chance of closing the deal is higher, rather than talking to someone who will be a good investor a year and a half from now.
Denis, thank you so much for joining this episode. It was really a pleasure to have you here. Thank you for your advice.
Thanks for having me. It was a pleasure to talking to everyone. Last but not the least, I wish all the best to all of you to succeed with building your business, raising your funding. And remember that fundraising, like an investments, is not the end of the journey. It's just the beginning. The most important part is what happens after you get this funding, and what you do with this funding so that your company succeeds.
That's some great advice. Thank you, Denis.